Welcome to the Deep Dive. Today, we're tackling a really polarizing name in fintech, Upstart Holdings, ticker UPST.
hmm
Is it the future of lending, this AI powerhouse? Or is it, more like a high-risk house of cards?
Yeah, it's a fascinating one. The ultimate Jekyll and Hyde stock, you could say.
Mm.
It's trading around $50 a share right now, as of October 1st, 2025.
Right.
And our job today, for you, the learner, is really to cut through the noise, apply some solid value investing principles.
Okay.
We need to figure out if this business is actually durable, if it's predictable, and frankly, if it's worth that $50 price tag, or is the risk just, well, baked in?
And we're going to walk you through some, frankly, surprising contradictions we found, digging into the sources, the
Wow.
financials, the market signals. They really reveal a major structural vulnerability.
That's right.
By the end of this deep dive, you'll get exactly why, despite some genuinely impressive tech, this company presents a dilemma that, well, maybe prudent long-term investors just can't ignore.
It lands squarely in the too hard pile for many. We'll
Yeah.
show you why.
Okay, let's start with the basics in our first segment. Chapter 1, Business Fundamentals. The AI-powered toll bridge.
Yeah.
So let's really define this. What exactly is Upstart? And maybe just as important, what does it claim not to be?
Yeah, that distinction is absolutely critical. First off, Upstart is not a bank. That's key.
Right.
It tries to avoid direct balance sheet credit risk. It operates
Yeah.
as a technology intermediary,
Yeah?
a matchmaker.
Like a high-tech marketplace. A toll bridge, as you sometimes call it.
Exactly, a toll bridge. It connects literally millions of consumers who need loans, personal, auto, now they're doing HELOCs too, with a network of, I think it's over 100 banks and credit unions now. They're the ones providing the actual capital. Upstart just, facilitates the whole thing, takes a fee.
And the numbers bear that out.
Right.
How do they actually make money?
Predominantly fee-based. If you look at Q2 2025, $241 million of their $257 million total revenue, that's what, 94% came from referral fees, servicing fees. So on paper, it looks like the perfect capital-light software model. High margins, scalable, supposedly low risk.
And the problem they're solving, the core idea, is that the traditional FICO score is just too simple. A blunt instrument, I think they call it.
That's the pitch. Their AI looks at supposedly over 1,500 different data points. Things well beyond FICO, like education, job history, non-traditional stuff.
To get a better read on risk.
To get a better read on risk, yeah. Which should lead to a win-win. More people get approved, maybe at better rates, and the banks lending the money should see lower defaults. Theoretically. But, and this is really the crucial nugget we have to focus on, the capital light contradiction. Because the financial reports, the sources, they show a dangerous complexity. That model, it kind of falls apart when things get tough.
Okay, so tell us what happens when the stress hits. What did we see?
Well, when the macro picture worsens, specifically think 2022, 2023, with those rapid interest rate hikes, the third-party capital, those banks, those credit unions, the institutional buyers, they got spooked. They became very risk-averse.
So they just stopped funding loans through Upstart.
Pretty much fled the platform, yeah. And Upstart, to keep loan volume up, to keep feeding data into its AI models, they were basically forced to step in and fund the loans themselves, using their own balance sheet.
Wait a minute. So the platform designed to offload risk onto lenders ended up forcing the platform operator, Upstart, to take on that very risk.
That's exactly what happened. And you see the proof, the smoking gun, right there on the Q2 2025 balance sheet. It showed over $1 billion with a B in loans at fair value.
Wow.
A true marketplace, a true toll bridge, shouldn't be holding that much inventory, especially when that inventory is potentially risky loans.
Yeah, that doesn't sound very capital light.
Not at all. It proves that when capital gets scarce, Upstart basically morphs into this hybrid lender. It takes on the cyclical credit risk the whole business model was designed to avoid, so it's structurally way more complex and frankly more dangerous than just looking at that fee revenue would suggest.
Okay, so if the core business model has this inherent risk, this dependence on partner confidence, that leads us straight to the next big question. Chapter 2. The economic moat. Is the AI advantage durable? Because their whole future, everything, really hinges on that AI being a lasting competitive advantage, right? A strong moat.
That's the thesis. They argue they have what they call a data flywheel effect.
I'll get the flywheel.
Right. They track, I think the number is over 91 million repayment events every single month. So more data feeds smarter models, which theoretically leads to better loan performance.
Which attracts more banks and more borrowers.
Exactly. Which generates even more data. It's a virtuous cycle, supposedly. And they do have some tangible results to point to. That loan conversion rate, it jumped dramatically. It was down around 10% in 2023, but by Q2 2025, it was up near 24%.
That does sound impressive. Yeah. But hang on, if the AI is that good, why did the funding partners bail in 2022 and 2023? Doesn't that point to a weakness in the AI itself, not just the economy?
You've hit the absolute core challenge to the moat's durability. That's the central question. The AI models, which were largely trained during, a decade of unusually low interest rates and benign credit conditions,
Right.
they arguably failed to accurately price the risk during those volatile rate hikes of 22 and 23.
So the lenders lost confidence.
The lenders lost trust, yes. That failure demonstrated pretty clearly that the moat, while it might be brittle, it seems contingent entirely on the continuous, unwavering confidence of those funding partners. If they get nervous, the flywheel stops spinning.
And how does Upstart stack up against the competition? I mean, the revenue growth is eye-popping 102% year over year in Q2 2025, but they're still much smaller than, say, SoFi Technologies.
Much smaller. Upstart's market cap is around $5 billion. SoFi's is over $30 billion. And SoFi's quarterly revenue is much larger, too.
What's the key difference there structurally?
Well, scale is part of it, but the crucial difference is stability of funding. SoFi has a bank charter.
So they can use customer deposits.
Exactly. Cheap, stable customer deposits to fund their loans. Upstart is totally reliant on that third-party institutional funding, which we've just seen can be incredibly skittish.
So ironically, the company with the explosive growth might actually be the most vulnerable in the sector because its funding is so fragile.
That's the paradox, yeah. The high-growth leader might also be the one walking the tightest rope.
Okay, let's shift focus now to the people in charge. Chapter 3. Management, scorecard, rational operators, or growth chasers. I mean, you look at their backgrounds, the leadership team, lots from Google, high tech. They're clearly brilliant innovators. They did manage to get the company back to GAAP profitability in Q2 2025.
No question, their technical execution is strong. They can build product, they can innovate, but the foresight, the risk management, that deserves some real scrutiny.
Because of the 2020-2023 situation.
Primarily, yes. The failure to really anticipate or at least effectively manage the business through that downturn, it does raise serious questions. Some analysts pretty bluntly concluded it showed a demonstrated inability to manage the business through macroeconomic downturns.
Ouch.
Yeah. Brilliance at tech innovation doesn't automatically translate to skill in managing macro risks or, crucially, capital allocation.
Right, capital allocation. Let's talk about that. The share buyback they announced back in February 2022 for $400 million. How does that look in hindsight?
It looks pretty bad, frankly. It's a classic potential red flag. They authorized this huge buyback and then spent about $125 million buying shares as the stock was collapsing.
So not exactly buying low.
Not at all. It looks reactive, maybe trying to signal confidence to the market rather than a disciplined decision based on the stock being truly undervalued. It definitely casts doubt on their judgment as rational capital allocators.
And is there other evidence about how management views the stock's value?
Oh, yes. And this is probably the most telling indicator of all. Insider activity.
The buying and selling by executives and directors.
Exactly. The data here is stark. Over the last 12 months, insiders have sold Upstart shares 83 times.
83 sells. How many buys?
Only 15 buys? Net, they sold over 1 million shares.
1 million shares sold by insiders.
Think about what that signals. The people who know the absolute most about the company's inner workings, its true prospects, its real risks,
Yeah.
they apparently do not see the current $50 share price as a bargain. In fact, they seem to be actively, consistently taking money off the table. That's a powerful signal for any investor to consider.
All right, let's move from the people and strategy to the hard numbers. Chapter 4. Reading the financial story. A tale of volatility and recovery. The income statement alone tells a pretty wild story, doesn't it? Especially that revenue growth.
Wild is a good word for it. It's the very definition of extreme cyclical sensitivity. You had revenue growth hitting, what was it, an astonishing 264% back in 2021.
Incredible.
Then collapse, it fell negative 39% in 2023. And then by mid-2025, it bounced back to TTM growth of 61%.
That kind of swing is just huge.
It's massive. It just shows that the company's underlying earnings power is incredibly unpredictable. It seems entirely at the mercy of the credit cycle and funding availability.
But the really critical financial piece, the thing that makes you scratch your head, is the cash flow statement, right?
Mm-hmm.
You mentioned they got back to GAAP profitability in Q2 2025, a net income of $5.6 million.
They did. They celebrated that return to profitability on paper.
Right.
But their cash flow from operations during that same quarter was negative $120 million, which resulted in a negative free cash flow of over $227 million.
Okay, hold on. How can a company report a profit but be burning through that much cash?
Okay.
Where's it going?
This is where that capital-light contradiction smacks you right in the face on the financial statements.
Ah, the loans they had to buy themselves.
Exactly. The company is burning cash precisely because it's forced to use its own capital to fund those loans we talked about, the ones its partners didn't want. When Upstart uses its cash to buy or originate a loan that stays on its balance sheet, that cash outflow hits the operations section of the cash flow statement.
So it instantly makes their cash flow profile look like
a high-risk lender, not a scalable tech platform. It looks like a company that has to constantly find cash simply to fund its inventory, which happens to be loans. They have to keep feeding the machine with their own money.
So they might make a small fee on paper for originating the loan, but they're spending hundreds of millions in actual cash to hold on to the loan itself.
That's the dynamic. And you see this risk profile echoed on the balance sheet too, with leverage. Their debt-to-equity ratio is up around 2.07 or 207%.
It sounds high for a tech company.
It's very high for a tech company. It looks much more like the leverage profile of a financial institution, like a bank or a specialty lender. And that leverage just adds another layer of fragility, another risk factor, especially heading into any potential economic downturn. Okay, so we've laid out the business model issues, the moat questions, the management concerns, and now the financial picture, particularly the cash burn. Let's try and put a price on this thing. Chapter 5. The price of the future, calculating intrinsic value.
This feels like the really tricky part for Upstart. If you're an investor who focuses on, current financial reality, trying to calculate intrinsic value with a discounted cash flow model, a DCF, it seems almost impossible here, doesn't it, given they're burning cash?
It's incredibly difficult, bordering on impossible if you're being conservative. The current valuation, that $50 share price, it isn't based on current earnings or current cash flow. It's based almost entirely on future potential. Hope, essentially.
So to even get close to justifying $50 a share today, what kind of assumptions do you need to bake into a model?
You have to make some highly optimistic assumptions. First, because of all the risks we've discussed, you absolutely need to use a high discount rate in your DCF, probably somewhere in the 10% to 12% range, maybe even higher.
Okay, reflecting the risk.
Right. But then you also have to assume a near-flawless decade-long journey from significant cash burn today to achieving really high, stable profitability and free cash flow generation. You need to pencil in free cash flow margins hitting maybe 15%, 20% by year 10 and sustaining that.
That sounds like assuming everything goes perfectly. No more funding crises, smooth sailing on the economy.
Exactly. It requires a very smooth transition. And the scary part is the final valuation number you get out of that kind of model is incredibly fragile. Meaning, if you just tweak those optimistic assumptions slightly, maybe assume slightly lower margins or a slightly slower growth ramp, or factor in even one hiccup along the way, the calculated intrinsic value can swing dramatically downward. It just confirms how much uncertainty and hope is embedded in that current stock price.
All right, let's talk about protection. Let's put on the value investor's parachute in this next section, Chapter 6. Margin of safety investing with a parachute.
So at around $51 a share, does Upstart offer any kind of discount, any margin of safety for an investor?
In a word, no. Absolutely not. From a traditional value perspective, the stock is, by most metrics, highly valued. That price-to-sales ratio we mentioned, around 6.07, is steep.
Reflecting very high expectations.
Exactly. It reflects baked-in expectations for near-perfect execution and massive future growth. There's certainly no discernible discount in the price today to compensate an investor for taking on all the fundamental operational and structural risks we've identified.
And remind us, what are those key risks that should demand a significant discount, maybe 40% or even 50%? Well, there are three big ones. First, funding risk. That's the Achilles heel. We saw it play out in 2023. The third-party capital providers proved they will flee when conditions get tough. That risk hasn't gone away.
Okay, number one.
Second, macroeconomic risk. We've seen the extreme sensitivity to interest rates, unemployment. This business cycle matters immensely to Upstart.
Got it.
And third, increasingly, regulatory risk. There's growing scrutiny globally on AI bias in lending, fair lending practices, compliance costs. New regulations could potentially blunt Upstart's claimed technological edge or increase their operating costs significantly.
Okay, those are serious risks. Is there anything else indicating how the market views these risks?
Yes, there's one more really important piece of data. The short interest.
The number of shares being bet against the company.
Precisely. And for Upstart, the short interest is exceptionally high. It's been hovering near 28% of the public float.
28%, that's huge.
It's massive. And look, this isn't just noise from retail traders. A short interest that high represents a collective, sophisticated, and very well-capitalized bet placed by experienced institutional investors. They are explicitly betting against the long-term durability of Upstart's business model.
What are they likely betting on specifically?
They're likely betting that the funding risk, that Achilles' heel, will inevitably bite again during the next credit crunch or economic downturn. They're betting that even great AI is useless if you don't have the capital partners willing to fund the loans. Ignoring such a strong collective market signal would be, I think, a grave error in risk assessment for any potential long-term investor.
Okay, this brings us to the end, wrapping it all up. Chapter 7. The final verdict to buy or not to buy. Let's synthesize everything we've uncovered against those key value investing criteria that you, our listeners, need to think about.
Let's do it. First, the business itself. We found it has this fragile dual nature. It looks like a high-margin platform in good times, but it morphs into a cash-burning, highly leveraged lender when the environment gets tough. That's contradiction number one.
Okay. Second, the moat.
The moat, the AI advantage. It's definitely promising. The tech is impressive. But it proved brittle. It hasn't yet demonstrated resilience in securing partner trust during severe economic stress, unproven in tough conditions.
Third, management.
Brilliant technologists, no doubt. But questionable capital allocation decisions, like that reactive buyback, coupled with the heavy insider selling. It raises serious flags about their foresight, discipline, and maybe even their own conviction in the long-term value proposition at this price.
And finally, the price.
The price. At around $51, it offers zero margin of safety. You're paying a premium valuation that demands aggressive growth and near-perfect execution, despite all the substantial demonstrated risks.
This is pulling it all together. What's the final judgment?
The final judgment is pretty clear, I think. Upstart Holdings is undeniably innovative. It's a fascinating company to watch. But it fundamentally fails the critical tests of all-weather resilience and predictability that a prudent value investor looks for.
Too many risks.
Too many risks, yes. The high operational risk, particularly that structural negative free cash flow driven by the need to self-fund loans. Combine that with the fragile funding model, the questionable capital allocation, and the high valuation. It just pushes Upstart squarely into the too hard pile.
So, for a value investor focused on protecting capital first,
it's a definitive pass. Fascinating technology, interesting story, but not a compelling investment case from a risk-adjusted perspective today.
You know, the ultimate question this leaves us wrestling with is whether those recent AI model improvements they talk about, like the Upstart Macro Index, are genuinely enough this time. Can they really prevent another crisis of confidence among their capital partners when the next downturn inevitably hits? Can the AI truly become all-weather? Or will this model always, fundamentally, require a relatively benign economic backdrop to truly succeed and justify its valuation?
That really is the multi-billion-dollar question, isn't it? Only time and the next cycle will tell.
Indeed. Well, if you appreciate this deep dive, this kind of analysis where we dissect stocks like Upstart using a value investing lens, please remember to like and subscribe to Stock Analytics AI.
Yeah, your support helps us keep doing these.
Absolutely. And remember, our members, it's just €4.99 a month, get priority deep dives on tickers. We're actually planning to cover all of the S&P 500 stocks over the next few months, and members get that exclusive priority access.
That's a big project.
It is. And hey, if you just want a one-off deep dive on a specific company you're interested in, just drop us a super thanks on the video.
And of course, the important reminder, please remember that this deep dive is based on publicly available source material and our AI-driven research tools. It's for educational purposes. Always perform your own due diligence. Talk to a qualified financial advisor before making any investment decisions. This is not investment advice.
Couldn't have said it better myself. Thanks for joining us on the deep dive.